I want to thank everyone who's joining us. I know time is your most precious resource, and so we really appreciate you spending your time with us. Today, we're going to cover, we got a lot of questions. Thank you so much to everyone who submitted those. We will talk about patient capital, who we are and what we do. We got a lot of questions on that. And of course, the current environment. There's a lot of headlines out there that people are really interested in. So we will dive in there and the opportunity set. And for those of you who are short on time, I'm going to summarize the key points right up front, which is, one, it's my belief that there's near hysteria out there about an AI bubble. And the good news about that is when there's hysteria about a bubble, it's probably not a bubble. So I've heard many people say many times things about this bubble, and we'll get into that. But usually bubbles don't peak with everyone saying we're at the peak of a bubble. Second, I think we are in a bull market. It's, a secular bull market started in March of 2009. We'll talk more about that. But the correct posture in a bull market is to be bullish. And people have made an error on that for almost the entirety of the bull market. Jesse Livermore is quoted in the great book, Reminiscences of a Stock Operator, which is at the top of Bill Miller's recommended reading list for everyone who asks him, as long as I've known him, about what books they should read. So Jesse Livermore has great quotes on this. So I'm just going to read a couple. One of them says, "It is no trick at all to be right on the market. You always find lots of early bulls in bull markets and early bears in bear markets. I've known many men who were right at exactly the right time and began buying or selling stocks when prices were at the very level which should show the greatest profit. And their experience invariably matched mine. That is, they made no real money out of it. Men who both be right and sit tight are uncommon. I found it one of the hardest things to learn, but it is only after a stock operator has firmly grasped this that he can make big money." Another one was, "This is about all I have learned, to study general conditions, to take a position and stick to it. I can wait without a twinge of impatience. I can see a setback without being shaken, knowing that it's only temporary." So, one of the most important things he talks about is patience, which is very important to us at Patient Capital. But again, and we'll get into this more, I think we're in a bull market and you want to be bullish in a bull market. And then lastly, valuations and sentiment have risen. They are at the high, near high ends of the range in terms of valuations. We'll get into that. Sentiment, you are seeing certainly more optimism than you did a decade ago or, at the beginning of this secular bull market. And in some places, it is euphoric and speculative. And so, that warrants, careful attention and consideration. And for us, and how we look at the world, we aren't in those areas. And so, again, I think there's higher risk in certain areas of the market. And again, what we do is we avoid those areas. So we will start the presentation now. Christy, you can go to the first slide. The next, yeah. So Patient Capital, we are a 2.4 billion, asset manager in Baltimore. I think the key things to know about us, I started the firm in 2020 as a part of Miller Value Partners after working with Bill Miller for over 2 decades. And I feel extremely fortunate, to have landed as a junior analyst with Bill many, many years ago, because I got to learn and study a philosophy and process that I have great, great conviction in. And that philosophy and process, started, over 40 years ago with Bill and his partner, Ernie Keeney at Legg Mason. We're always trying to evolve and improve, but some of the best investment minds in the world, like Bill and Michael Mauboussin, worked on this process. And so I am a student of it. I am a practitioner of it. I have a significant belief in it, and I believe it can work in many, many environments. I think the key things to know about us is we have a great team. The investment team, most of us have been together for a long time, over a decade, doing what we do. All of us actually started as little junior baby analysts, and we were brought in on the ground level to learn, our unique way of doing things. And then we talk about our partnership purpose. We do want to be the most investor-friendly active management company. Now, that is a very tall order, so I don't take that lightly. We have a lot of work to deliver on that. But when we're making decisions, we're really always thinking what is in the best interest of our investors. In this business, there's oftentimes, contradictory things that you can do for the business versus the investors. We are always thinking what is in the best interest of investors. And then it all shakes out in performance, and that's what we're paid to do, is deliver that performance. In terms of our philosophy and process, we are long-term value investors, but what I want to reinforce is, what we do is we look at business and fundamentals, or the underlying fundamentals. A lot goes into that. We're trying to determine the intrinsic value of businesses, and that's a lot of work goes into that, and it's a range of potential outcomes. And then we're comparing it to market expectations. And so we're looking for areas where there's a disconnect and there's an opportunity there. And we think we have a variant perception from the market, and we think the market's wrong, and mostly the market is not wrong, and it's very, very difficult to beat. And so our analysis, looks at both of these things distinctly and separately. Some people say they just invest in quality companies. They look for the highest quality companies they can, and that has actually worked really well recently, and quality valuations have risen. But there are time periods where that has worked really poorly, like at the peak of the Nifty 50 bubble, or the peak of the tech bubble, because even the highest quality companies can be overpriced and poor investments. And similarly, the worst companies can be priced too low. Now, I think there's much higher risk if you're investing in really bad companies, and so we take that into consideration. But when we're thinking about whether there's an AI bubble, when we're thinking about whether there's an opportunity in a stock, we're looking at, what's the market tell us needs to happen, and how does that compare to our assessment of the underlying fundamentals? Again, the main point here that I keep reiterating, there's so many headlines in markets, so much news that surfaces every day, that it's often very helpful to step back and think on a longer term basis, where are we? And that's a different perspective. So again, we're in one of the longest, strongest secular bull markets that we've ever had. The market bottomed in March of 2009, and the S&P 500 is up 10 times since then. That's a 10 bagger in Peter Lynch parlance, and it's hard to do that at the market level. It's hard to even do that at a company level, but it's much easier than the market level. So the annualized returns have been 17% a year, much higher than the long-term average that's closer to 10%. And Opportunity Trust during that period has been able to deliver 18.5% return, so 150 basis points better than the market. So at the start of this period, there was pure panic and very low valuations. That was a great money-making opportunity, but it didn't necessarily feel like that to anyone who existed at the time. And now we're at much higher levels of valuations and more optimism, although there's still significant skepticism, in my opinion, that exists. Christy, you can go on to the next slide. We love to show this one because I think when it comes to where are we in the market, this is your key barometer. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And so I remember being at a dinner in October of 2008. The market was crashing. It was with Bill and a couple of other money managers, and they were extremely concerned and worried about the state of the world. And I was just a dumb kid at the time. And I remember saying, but isn't this great? It must be the best opportunity in the whole world. That's how my twisted brain works. And I was too far removed probably from clients to recognize the reality of what managing money in that environment looked like. In hindsight, over the long term, and Buffett wrote a piece then, it was, but no one felt like that. People were losing a lot of money, and you couldn't find anyone that was bullish. It was hard to find anyone. Fast forward to today, and there's much greater optimism, and we are seeing signs of bull market behavior that we really haven't seen since the late 90s, with a lot of younger people trading in the market and making big sums of money and doing this for a profession. We have in the quantum area stocks that have no revenues and no real business up 20 to 50 times in the past year. So if you have a good headline and a good dream, there's been huge moves. People are concerned about NVIDIA's financing of some of its customers, and so that warrants attention. So you are seeing some activities. Again, I think that makes a lot of sense for NVIDIA, and I can get into that. But at the same time, it's a very unique environment because you're still seeing signs of significant pessimism, or at least skepticism. So the CNN Fear and Greed Index just registered a hint above its lowest level, which it classifies as extreme fear. The San Francisco Fed Daily Economic News Sentiment Index is below 85% of readings since it started in January 1980. The OECD US Consumer Confidence Index is lower than over 99% of that it's been since it started in 1960. And so there really is this bifurcation, and you even see that in the investor community, with younger retail investors doing YOLO, you only live once, FOMO, fear of missing out trading, driving some of the speculation. But older retail investors, much more conservative, with significant amounts of money in money market funds. I think, endowments and foundations are moving out the risk curve, but they're still pretty conservative. Again, it just doesn't look to me at all like, peak bubble conditions. And the later stages of secular bull markets, do coincide with some of the best returns. You usually get the best returns off the lows in that recovery period, and then in the years before a peak. From 95 through 99, there was 5 years where the S&P 500 was up 20% or more. It was 19.5 in the first years, but it rounded up to 20. So that is stunning. We've had 2 of those years, 23 and 24, the S&P was up over 20% after a down 18% year. We could have another one this year. So again, a strong return period, and that is what you would expect as you get into the later stages, but it doesn't mean it's anywhere close to ending, and I'll get into that. Again, I just think there's bubble mania, and when everyone's calling for a bubble, there's usually not one, because that means it's priced in, and there's enough conservatism, concern priced in, that it's typically not where people throw in the towel like they did in the late 2000s. So you can see here, there's been a bunch of comments on this. David Solomon, I wouldn't be surprised if the next 12 to 24 months we see a drawdown. Jeff Bezos, industrial bubble. Now, those comments were both made in the context of much more positive comments. Paul Tudor Jones, all ingredients are in place for some kind of blow off top. Now, he said he expected, the late 90s, you had a 40% up market over the next 6 months. So again, huge gains. Rob Arnott, AI is a real deal. It's still a bubble. Again, you can see Cisco moment, the CIO of Morgan Stanley Wealth Management. Jamie Dimon thinks there's 30% of a correction. That was less in relation to an AI bubble and more in relation to, inflation, interest rates, the market price for perfection. Now, a correction and a sell-off can happen at any time. But again, that doesn't, even if it were to occur, that doesn't mean, it's peak bubble conditions or a bubble. Again, here's a fun little cartoon. A mom and a dad, their poor kids are trying to just have fun with their bubbles. And the mom says to the dad, you don't need to remind them every time that the bubble's going to burst, taking all the joy out of it. And I feel like that's kind of where we are in the market now. Howard Marks had a great piece that he wrote in January of this year on this topic. He actually wrote a piece in January of 2000 at almost the perfect time, about how we were in a bubble then. And he called it perfectly. His piece this year went through all the puts and takes on both sides. And again, the reason that expectations are up. But I thought his key point, again, he said he didn't think we were at those kind of excesses. And I agree with that. And his key point, in my opinion, was that it's psychological extremeness that marks a bubble. So it's everyone being on the same side of the ship where you just can go no longer, and then it's unsustainable like a bubble. That's the key defining feature of it. And on the other hand, Alan Greenspan called irrational exuberance in December of '96. And I think even at the lows of the sell-off, we maintained levels above that. So timing really matters when you're thinking about these sort of things. Again, I think if you look at how well the market's doing, both over the past few years and over a longer term, during this secular bull market, it's all about technology. And this chart shows the growth rate of S&P earnings, how high those are above nominal US GDP growth. So what you can see here is all sectors of the market is the dotted line, and then you exclude technology in the solid line. So you can see the dotted line is much higher than the solid line, which just shows how much growth has been driven by technology. And Jim Paulson put out a great piece on this on Monday, and he looked at what he called new era tech spend. And so that was spend on information processing equipment and intellectual property. And he pointed out that in the first 5 bull markets, in the post-war period, the percentage of GDP that was spent on this new era tech spend was under 1%. So it was really a non-factor, and the amount of growth coming from this spend was under 2%. So again, just a non-factor. If you look at the 1990s, the percentage of GDP that was spent on tech was 2.7%, and the impact on growth over that period, it was 8.2% of growth. So more material. And then if you look at this bull market, it's been 8.7% of real GDP. That is getting to be meaningful. It's over 3 times what it was in the 90s. That's the real economy. And then the percentage of growth is about 19%. So it's a significant chunk of our economic growth. And so that's the fundamentals. When we think of fundamentals versus expectations, that's the fundamentals piece. And that has had a big impact on the market because it's led to improving margins, returns on capital, free cash flow generation, and justified valuations. And so if you look at the market, the stunning market gains that we're seeing, they are being driven by the fundamentals. So in the late 90s, technology was 40% of the market gains, and it was 11% of the index. So a very small part of the market was driving the bulk of the gains. Again, that's getting out of whack. Currently, it's 44% of the market gains, and it's 30% of the index. So again, those are much more, in line, the fundamentals and the market movements. Which again, to us says it's more sustainable. Investors really fear the large capital spend. I think that's what's making everyone concerned, and there's good reason to, because historically, when companies and industries really increase their capex, that's not a good sign. But again, it doesn't mean that it is never a good sign or it's never sustainable. So you can see here, the bar chart just shows the hyperscaler capex. We've seen huge growth in this as we build out the accelerating computing infrastructure that Jensen Huang, CEO of NVIDIA, talks about. So yes, these numbers are large, and there's a fear that they're not going to earn adequate returns. Chris, you can go into the next page. But so far, there's no evidence of that. There's actually evidence that they are earning adequate returns. So this looks at the tech sector. Actually, it's the Mag 8. CSFB Holt put this together. I guess it's UBS Holt now. And they actually look at, given the capital deployed, what kind of returns are earned on that. And you can see that there's been significant growth in economic profits from these big spenders. And then on a longer term basis, you can see the chart shows the percentage of the market economic profits versus the market cap. And these have moved in lockstep. So as these amazing companies, the best companies in the history of the world, in many cases, have grown their contribution to the market, so has their percentage of the market grown. Again, that makes a lot of sense. You can go on to the next one. And also, the return on investment has continued to improve as well. So the incremental returns on investment are not as high given the denominator effect, but they are earning, returns on these investments. And I was at a conference, the Robinhood conference last week. Dario Amodei, the CEO of Anthropic, spoke, and he addressed the concern that people have that that they will not be able to earn a return on the spend. And he made the point that on a model basis, which is a more unit economic basis, there are already strong returns on these models. So they develop a model, you look at the cost to develop it, then you look at what they're earning on it. They're earning good returns on that already in the market. The reason the companies are not, especially the new companies that don't have other businesses, are not earning good returns is because they're investing so much in the next generation model. And so, again, they will continue to do that as long as they see this improvement and as long as they see the returns. But if they stop seeing the returns, that investment, will fall. Again, we're not seeing that yet. They're still undersupplied relative to the demand they see in the marketplace. And again, valuations. Yes, tech's trading at the 70th percentile, so relatively expensive. Relative to history, just like the market overall, but it's not out of line with the market. Again, if you see a bubble, usually you have a small segment of the market where the valuations get out of whack. And both with the underlying fundamentals and the rest of the market, we are not seeing that. Here, it just looks at the overall market level. Again, valuations, this is a big concern for people. We're at 23 times earnings. The market peaked, in 99, 2000 at about 25 times earnings. So we're getting close. But I think the key things to remember, one, we're still lower. At that time, 10-year interest rates were 6%. Now they're 4%. So that justifies a higher valuation. With lower interest rates. We have better returns on capital. We have better free cash flow generation. We have better free cash flow margins. All of those things justify a higher valuation than what we saw then. And we have compared this period to, the Nifty 50 period or the tech bubble period in terms of trying to understand, when we were previously in later stages of secular tops, so that we can be aware of, anything that might pose a risk. And people have asked me, okay, so if it's like the tech bubble, then what year are we? And again, Paul Tudor Jones said we're 99. I've been saying we're 98. So if you roll it forward, that would put me in line with him. But actually, what I've been using to judge still puts me in 98. So, and the reason I say that is, my good friend Lauren Taylor Wolfe was on CNBC this morning, and she was saying, definitely we're in a bubble, no doubt about it, like it's gonna pop. She compared NVIDIA to Cisco, which has been the comparison that everyone's made, which I think has kept NVIDIA's valuation reasonable and attractive and removed a lot of the risk. Cisco peaked at 124 times earnings. It was, peak earnings and peak valuation. That's what a true bubble looks like. Currently, NVIDIA is at 31 times forward 12-month earnings. So way below that. So I went back and looked at, okay, when was Cisco at a comparable valuation? And it was at the same valuation in January of 1998. So early 98. And, from that point in time through the peak, Cisco was up 526%. Huge, stunning gains in Cisco. The S&P was up 45%. So that was in a compressed period, just huge gains. That's what a secular bull market peak, I think, looks like. Interestingly, if you look at NVIDIA, the NVIDIA is up about 26% over the past year. Its next 12 months earning estimate is up 56%. So the multiples actually compressed. Again, that's very unlike what you saw at the peak of the tech bubble. And I think that has to do with all these concerns of people saying it's a bubble. So again, I like that. That's keeping expectations, reasonably contained, overall. And so if you bought in January of 1998, Cisco, because then people say, okay, but you're just playing with fire. It might go up a lot, but then you're going to crash and burn. Well, not so much. So if you look at the 5-year returns from January 98 of Cisco, to January of 2003, so that was close to the lows, a little off the lows. Cisco was up 32%, so 5.7% a year. Those are subpar returns, but they're not terrible. You made money. The S&P was down 8%, down 1.6% a year. That's about as bad as it gets for 5-year type returns. If you look now, these are very, very sensitive to starting and ending point. So if you even roll that forward for 1 year, so the 6-year returns for Cisco through early 2004, Cisco was up 145%. So you would have compounded at 16% a year. So again, you just have to not exit, during the weakness, and you did excellent in Cisco from this point. The S&P was up 26% or 3.9% a year over those 6 years, subpar. The small cap index was up 64% or 8.6% a year. So again, we're trying to survey broadly the opportunity set, how market expectations are comparing to those fundamentals, and then position a portfolio that can do well in a variety of environments because we don't know what the future holds. This point is, this looks at the data points on the market's valuation relative to its subsequent 1 and 5-year returns. You can see on a 1-year basis, it's all over the map. Given the point we are now, you have some very strong returns, some very weak returns. The R squared is only 6%, so it's actually not a great indicator of what the market will do. It's basically noise. Over 5 years, the R squared is a little higher, 32. It's still not that high, but it's much higher. So that usually when you have higher return period or higher valuations, that does over the long term lead to lower returns. If you look over the long term, real earnings have grown in the mid 3s, and we have current break-even inflation rates, at 2.3%. So if you just add those together and say current valuations are reasonable, which I would say, given the fundamentals, they are. Although if the fundamentals change, that would change that. That would imply 6%-ish, long-term returns from here. We still have very high dispersion in the market, valuation dispersion. That's really good for stock pickers and for people like us. You can see here, the median S&P is up just shy of 20%. It's above, 20% above its long-term historical average. You can see at the high end, those high-end valuations, the darlings are, at peak levels. At the low end, interestingly, there's not much, improvement at that low end of the market. So again, I think that speaks to the pressures on value investors, the fewer people you have looking at those sort of opportunities, which in my opinion, eventually will become probably the best, most attractive area in the market, but that could take a while. For us, we're always looking for areas where we have depressed expectations and good fundamentals. And one example of that recently is in the healthcare index. It recently was at 50-year relative valuation lows relative to the rest of the market. You can see here we're at the lowest we've been since the early to mid 70s in terms of the performance, oversold aspects of the market. Usually when we have these fears about these policy fears about healthcare being at risk, historically, the 3-year returns have been, 25% a year. So this weight has grown substantially. It's 26% of opportunity versus the S&P at 9%. And so I will take you through a few of our top ideas. And we have AI exposure tech names. We will get into some of that in the questions. But what I think is important is we have, a number of other names that are, well diversified from the names that everyone talks about all the time. And I think these names that I'm going to talk about, I think they all have significant compounding potential, again, mid-teens or higher. And if we're looking at market returns, of 6 to 8%, call it longer term, again, it could be much, much higher in the next few years, then I think these names will massively outperform. So you will, if you've listened to our calls or me, there a lot of these names I've talked about before, but I will just go through them. So Norwegian Cruise Lines, I think is extremely attractive. It's 23 or $24 a share. I think it has mid-teens compounding potential. The cruise industry overall is a very small percentage of vacation spend, 2 to 3%. There is capacity constraints because there's only a few shipyards. And so this industry can't, go on a wild growth spree, which will keep discipline in the industry overall. Cruises are a great value relative to other vacations, 20 to 30% cheaper. And I like Norwegian. It's the smallest of the big three with some of the best growth prospects from this level. And, maybe even more importantly, the company has a new management team and they're undergoing a big shift in terms of how they manage the company with a greater emphasis on return on capital. And usually when we see that at a company, it is transformational and really improves the company's performance. And so I think Norwegian can grow its earnings, in the mid-teens, 15% a year. We have here the next 5 years, but again, I think they can do it even longer than that. It is cyclical, although I think people are prioritizing experience spend, and older demographics are, less exposed to the job market than other areas. It's still over-levered. It's delevering. As it does that, I expect the multiple to expand closer to competitors, Carnival and Royal, that have traded an average of 16 times 2025 earnings. Norwegian is at 11 times. I think it can earn, $3 a share in 2027. If it does that and trades at, 13 to 14 times, it's worth 40 to 42 from a current price of 24. So that would compound over 30% a year. On a longer term basis, this is probably closer to the teens, and it's unclear how long it will take that multiple to normalize. But I think this is a very attractive idea. Another one, United Healthcare, we added to this starting in the second quarter, added aggressively in the third quarter as it continued to sell off, on extreme market weakness. Today it's, 367. I think it closed today. So it's had a big recovery. Our average price is 289. So, we got in, when it was at its weakest point. Again, the concern was this was a darling that executed and delivered every quarter for many, many years. When those kind of companies disappoint, it's ugly because people, run for the doors. So they're undergoing an earnings cycle, and they have depressed earnings, as is the whole industry. And we think that they'll be able to recover their earnings and grow, earnings in the mid-teens over the next 3 to 5 years. Again, if they do that, we think the stock can compound in the mid-teens. QXO is another one of our largest positions and a company that we're really excited about. The stock trades for about $19 a share. We think over 5 years it can go to 50. So that's a 20% plus compounding rate. It was started by serial entrepreneur Brad Jacobs. He has delivered amazing results in the past at many companies, including United Waste, United Rentals, XPO Logistics. He's delivered, 10 baggers and 25% compound rate type opportunities. He wants to disrupt the building products industry. He just did his first acquisition of Beacon Roofing. He will do more. We met with him a few weeks ago, and he couldn't be more impressive. He has extremely impressive business acumen, a good understanding of capital allocation, and how you drive value and create value. There's a greater opportunity to improve Beacon than even he thought, and he'll layer in, more opportunities over time. And so we think this one, again, we're assuming more acquisitions over time in these numbers, but we think, it can earn over $2 a share in 2030. Again, the stock's 19 now. So for a quality compounder, the upside is, quite extreme. Those things usually trade 25, 30 times earnings. Lastly, Royalty Pharma. I think this is a very misunderstood company. It's the leading healthcare biopharma royalty investor. They have a long history of delivering returns. They initially had a fund structure, then they became a public company, and they've delivered returns, unlevered returns in the low teens, 13%, and then with leverage, those have been high teens. The concern about this one is that there's a lot of competitive dollars coming into the industry that's going to drive down returns. We haven't seen that yet. I think that the competitive advantages are underestimated. So the stock's at, 35, 36, $37 a share today. They dominate large deals, and there's not many people out there that can compete for the very large deals. I think they're 70% of the market for deals $500 million and over. They just did this deal with Revolution Medicines. They're always doing the best deals. We've been on the other side of a number of their deals, as of other investors I've talked to in the industry. They're really good at identifying what the most attractive deals are. And so Revolution Medicines, an investor, a healthcare investor, pitched that when I was at Robinhood and thought there was extreme upside. That deal was transformational because they basically structured a deal where they will continue to fund the pipeline over the coming years. They have cancer drugs, including a pancreatic cancer drug that we'll get results on next year. People are really excited about that. They have other drugs coming along. And they said that they have been getting so many calls since they did that deal because now the industry realizes they're an alternative to pharma partnerships or to selling to pharma. So again, unlocking a huge market. And I think that it reminds me of the alternative asset managers in the right after the financial crisis, where the KKRs and Apollos, Blackstones of the world traded at mid-single-digit multiples, and people said you can't put a multiple on the incentive earnings because they aren't sustainable, and you don't know if you can count on them. And now they trade at 30, 25 or 30 times. So we think owners' earnings for Royalty Pharma, which we calculate, is the best proxy of how they're doing. And that just looks at the cash flow of these royalty deals plus the amount they need to invest to sustain the current level of profits. So it trades at 13 times owners' earnings. We think they can grow that number, those earnings, in the low double digits, and in some scenarios much higher. But we think this company can compound, in the mid-teens, and it's not exposed to the economy, and it's not exposed to technology spend, and it's a great diversifier for us as well, and they're great capital allocators. So just to finish up, a couple things on the portfolio. Again, what I think of as our biggest assets are, again, that philosophy and process that I was, and the team here was fortunate to inherit and learn. Again, I think it's withstood the test of time, and I have a lot of confidence in it. And then it is our flexibility. And so I don't see many investment managers out there who can both, or like to both, invest in, beaten up, classic value stocks like Citigroup, that is one of our top positions and that is executing an amazing turnaround, but still only trades basically at tangible book value. And also, quality compounders like Amazon and Google, and also early stage companies that might be the most attractive opportunities of the future, like Coinbase and SoFi. And again, those sorts of companies all do well in different market environments. So I think the fact that we can have a diversified group of companies in our portfolio is a real asset. We are valuation, we are value investors. And so we are, for every name, looking at, the intrinsic value of the business versus where it's trading today. And the portfolio trades at a discount to the market. So it's 15 times earnings versus the market at 23, with better expected growth, over the next year. And as certain stocks do well and get closer, once they reach a point where we don't think they can outperform the market, we're selling them. We're redeploying it into names that we think are more attractive. In terms of what has been driving the portfolio, you can again see over a 1 quarter and a year-to-date basis, it's been diversified in terms of what's driving the portfolio. Precigen, which we will get into in the questions, is a big contributor, for both the quarter and the year. We did a private deal with them last year. in December, and that has worked out fabulously. But we also have our AI tech names like Alphabet, Alibaba, and Nvidia contributing. We have our financials because those are some of the best performers in the market, like Citigroup and SoFi. And then, some of our one-off best ideas like United Health and Norwegian and Royalty Pharma. And then our detractors have been, some companies that have been hit with tariffs over the quarter: Dave and Buster's, Crocs, Mattel. We still like all those companies. QXO, after doing really well earlier in the year, pulled back a little bit. IAC, has underperformed. We like all those companies and have been adding to most of them. On a year-to-date basis, a few additional ones like Cosmos and New Fortress have disappointed on fundamentals. And so those are names where we either have exited or are considering exiting, because again, that to us is an indication of risk. So with that, I think that's all we have for slides, so we can open up the questions.
Great. Thanks, Sam, for going through that. As Rebecca mentioned, we had a number of calls come in beforehand. We are also taking live calls. We are close on time, so we're going to try to get through as many as we can, but we will be in touch for any questions we cannot get to. We were excited to see that we have a lot of what seems to be investors new to our products and our strategies. So we were just going to hit on some questions that we've gotten from a number of people that can help them kind of ground themselves in what we do here at Patient. So Sam, if you could just kind of go through these rather quickly, they're more factual information. But we've got questions in terms of how we manage risk.
Risk management is critical. Again, I think most people focus so much on this to the detriment of their returns. So we want to manage risk to maximize returns. We don't want to manage risk to lower returns. And so if you look at endowments, over the past decade are up 6.8% a year when the S&P is up 13% a year. And hedge funds have delivered 4% a year returns because they're so focused on risk management. That is giving up a ton of, potential. So when it is important to, manage risk is if you have a big market downdraft. That's partially why we're so focused on what are the indicators we're seeing, where do we stack up relative to history. And then in this business, the best investors are right 50 to 60% of the time. That's the best you can do, which means you're wrong 40 to 50% of the time. Everyone's wrong a lot in this business because the future is uncertain and no one knows what happens in the future. So I think the important thing is to recognize as quickly as possible when you're wrong and exit. And so that's for us, we're looking at the fundamentals, not the stock price. When the stock price is really weak and the fundamentals are good, that's an opportunity we're adding. When the fundamentals are disappointing us and we have to have some idea on how we expect those fundamentals to evolve, then we're going to exit that name because that is a risk. And then the second thing is there's valuation risk. Again, we don't really take that risk because as a value investor, but if you're paying up top dollar, that's a risk, especially in certain environments, to your long-term returns. And then if you're all in one area, you want to be diversified enough because again, you don't know how the world evolves. And, some investors in this environment are underperforming because they don't have exposure to, some of these areas that are doing really well, like AI and tech. I think that's just as big a risk if you're interested in driving returns, which is what we're interested in doing.
And I would say one thing we're always focused on is tax efficiency. So can you kind of hit on how we manage that?
Yes, that's critical, but we are very active about managing losses because again, if companies have losses, we're looking to monetize those losses to offset gains. We might exit and come back to names. So we're well positioned, in terms of the loss.
In terms of the portfolio positioning, given, the current Fed policy, the easing, the inflation, is that impacting how we're positioning the portfolio and the names that we're finding interesting?
I think, we're always thinking about anything fundamental that's going on in the environment, and then how does that compare to market expectations? And so, small caps have lagged. They're only trading slightly above their long-term valuation level. And, the Fed is, lowering rates. And we've seen a correlation in markets with small cap performance doing better in environments where the Fed's lowering rates. So that could help them. I think that's one of the reasons that the financials are doing so well, because that yield curve has steepened until recently with a long-term 10-year sell-off. So again, we're looking at, what are the fundamentals in a variety of environments? What kind of stocks would do well in a variety of environments? And then we're trying to diversify. And so, yes, we're thinking about it. We're thinking about it in terms of how it might impact the performance of different securities, but we're, positioning from a bottoms-up basis on where we see the best risk-adjusted return.
And you brought up a good point with small caps. That's a question we got multiple times. Is there an opportunity in small cap that people should be considering? How do you think about our exposure there?
Yeah, so I think there's a number of really interesting small cap ideas in the portfolio, and I think our small caps are about a third now. If you look at names that are about 12.5 billion or less in market cap, and so those, I think the question is, do those start? They've already recovered, and the breadth of the market has broadened out, and small caps got back to previous highs, but they haven't massively outperformed. Do they start doing that when the Fed, continues to cut rates? Possibly. You have some people who believe, the economy will improve. In the late 2000s, they lagged as the market narrowed into the peak, and then they massively outperformed in the sell-off. So I don't have a strong view on which one of those will occur, but I want to be able to be positioned well in either of those scenarios. And so, I think we have stocks that can, do well, and we're positioning ourselves to do well in either of those circumstances.
And a favorite topic, we get this every time. It's something that I think makes us unique is our exposure to cryptocurrencies in general. We've been involved in the space for a while. One of the questions we got is it a speculation or is it an investment? And how do you think about valuing these types of assets?
Yeah, I mean, I sort of think that's a common question, and people who don't like it say you can't invest in it because it doesn't, create cash flow. You can narrow your investment world and those parameters. I think you can invest in Bitcoin, and how I've thought about it is, you know, is there a way to think about the underlying essence and value of it? And because I think of it as digital gold, then you can look at the market cap of gold, which is now 29 trillion and up over 50% in the past year. And if you look at the max amount of Bitcoins, 21 million that have been issued at current prices, it's about 2.4 trillion. So you have 12 times upside potential. And again, I think it is an earlier stage, and there aren't many gold out there. There's one. So I wasn't, it wasn't easy for me to say that, but once you saw the adoption pick up, and governments use it and people use it as a store of value, and again, younger people much more inclined to digital. So again, yes, I think because I have some proxy for what I think the value is, that you can think about it, in terms of an investment.
And then in some company names that we've gotten, you mentioned Precigen. We got more questions on Precigen than I think we ever have on any name. So I think we definitely have to hit on that. Can you kind of give your views on what you're thinking about the company from here and why you like it?
Yeah, so Precigen, for those who don't know, I mentioned we did a private transaction. It's a company we have a very long history with, in its former form of Intrexon. It changed management and focused on its healthcare assets as Precigen, and we have a long history with it. They had capital issues. They didn't have enough capital last year. Their first drug was, up for FDA approval in August of this year. The stock acted really poorly last year. We thought we could help solve their capital problem and get through that event, which we were very optimistic about, that drug and the approval decision. And so we led a deal. The stock is up a ton. When we led the deal, it was 75 cents. Ending July, it was like 175. So it had already done really well because, again, it had capital and, enough capital to comfortably move forward. They got the decision in August. The FDA approved the drug Papzimeos early and with a broader label than expected, which in this environment was shocking to the market, and the stock took off. And so it peaked on an intraday basis above 5, and it pulled back. It pulled back to the lows, about 40%, which is normally what you see, the kind of pullback you see after a drug approval. Again, we still think it has significant potential. It's a huge unmet need. These patients have to have, many 5 to 10 surgeries a year before they get treated on their larynx. It's totally devastating disease after, and it's just a shot with very good safety. They just announced some 3-year data where the majority of patients didn't need surgery again for 3 years. That's amazing. There's not any other good alternatives. So we think that indication, respiratory papillomatosis alone, is worth $5.50 a share. The stock, closed today around a little over $4 a share. They also have a really interesting pipeline. So they can use a similar drug on genital warts, which was caused by the same virus. Again, we think that could be worth $20 a share. They have, they're running clinical trials on HPV cancers. We think that could be worth $13 a share. And they have an ultra CAR T platform, which could be worth $16 a share. So that's $55 a share if you add that all up. And the stock's 4. So huge upside potential. Now, we don't think they'll be successful because that's not how these drugs across all those indications, although we do think the odds are better than, base rate for this company. But our probability weighted value for Precigen is $15 a share. So that's more than triple the current price. Now, it's a high risk, high reward company. So there is higher risk here because, again, they have one drug approved now and they have to commercialize it. The other drugs are in the pipeline.
Great. And then we're gonna go through a couple names quickly if we can hit on them. We got a question on IAC. Is that a broken thesis?
No, I love IAC. It's stock that hasn't worked. It's down, about 20% over the last 12 months, but the market cap's $2.8 billion. It has $2.1 billion in MGM stock and $900 billion in cash on the balance sheet. So there alone, you're at, $3 billion. And the stock, again, the market cap's at 2.8. They also own care.com, the most important assets, Dotdash Meredith. Again, Care's doing okay. Dotdash Meredith is doing well, very well, but Google and AI is kind of wreaking havoc in the open internet, and that is having some impact, but very manageable. I think the bigger problem is they have elevated corporate overhead because Barry Diller, who's back in the seat of CEO, wants to buy something. And so again, I think either they're going to buy something, and Barry's done a great job doing that historically, or they're going to cut that overhead, and they're doing both. They're buying back the stock. Again, Barry's very engaged in making improvements in terms of the stock performance. And so I continue to very much like IC.
Tempest AI, we talked about it before in a prior call, but somebody wanted to know our reason for owning it.
So I think it's a really interesting company. Again, I do think AI is transformational, and so I want us to be looking at opportunities in the space. So we came across Tempest AI. I think it has the potential to be a big healthcare winner in the AI space. It's early, but they've built up, a very unique data asset. Most of their business is in, the cancer space and, genetic testing and minimal residual disease, inherited disease. But they also have a licensing business where they can help pharma companies. They use their AI and the data partnerships that they have with all these hospitals, to help companies better fine-tune their clinical trials. They have a bunch of interesting stuff. They have an AFib, which is a heart, beat that goes wrong that can kill people. And they have a prediction model that's very accurate in that space, and it's already being used a lot. It's hard to get it reimbursed because there's no historical precedent for reimbursing a model like this, but they're working on it. So that also has, significant potential. So it's done extremely well because everything AI is done quite well. So now it's in the low 90s. Again, our assessment was, roughly that it was worth 95 to 100. So again, it's getting closer to what we think it's worth, but it's very early, in the life cycle there.
And then another healthcare name, one we've owned for a while, we've definitely gotten questions on, is Biogen.
Yeah, I think Biogen's extremely interesting stock. Christy, you can comment on it. She's the analyst that covers it. It has been a laggard until just recently. I think the problem for Biogen is it's had declines in the top line as their MS franchise, goes off patent. And they've done a good job. The new CEO has done a good job cutting costs, being opportunistic on the acquisition. I think there's huge potential with their Alzheimer's franchise. So the stock's at like 146 today, and I think we think it's worth, mid to high $200. And in, if things go really well in Alzheimer's, which now there's a blood test for it, which could improve, the treatment ratio, the upside could be much larger. Christy, do you have?
Yeah, you hit on all the key points. I would say they have a number of really attractive products that should come to market in like the 2028 period. And so what you see tend to happen is as the top line declines, as their MS franchise peters off, and their new products are not hitting the market until 2028, is that the market doesn't like to see that. But as Sam said, they've taken out a lot of costs. The return on investment is strong. They're being smart about how they're investing in M&A as well as R&D. And so we think that if you can look further out, 3 to 5 years, which is what we specialize in, is looking past the near-term noise, we can see really attractive outcomes from these drugs. And at the same time, you're seeing Alzheimer's pick up more than expected. And so that can be an attractive bump even over the near term because it can beat low expectations in the market. And so we think it's a very attractive setup. One last name in terms of company specific was Cosmos. You mentioned at the beginning, it's a name that we decided to exit given the deteriorating fundamentals, but if you could just hit on our thinking there.
Yeah, so I think we've exited in some funds, and other funds we still own it. I think the reason for that is just the specific circumstances of funding new ideas in certain funds and tax considerations in certain funds. So I think Cosmos has a lot of upside in certain scenarios if they, one, execute, and two, oil prices, Brent, stay above 60 to 65. So they're a highly levered business, and their execution has been disappointing. And so again, for us, when they have that disappointing performance on the fundamental side, they have performed worse than we expected. Then, we monitor the risk, and it's a candidate for selling. And so that has happened here at Cosmos. And I think, the challenge is they're kind of walking a tightrope over the next year. So they can't withstand a prolonged period. They have hedged more of their books, so they have a highly levered balance sheet, and they need to refi, a lot of debt over the coming years. So their performance is very subject to their ability to deliver on their production numbers, which they have not done, and their ability to, have the oil prices they need to drive profits. So I think it's high risk, and it is a candidate for bankruptcy. And so I think in this environment, those sort of names, we're cautious on. I think if they can drive production over the next couple quarters, that can remove a significant amount of risk. But again, they've struggled to do that.
And, you hit on some of the idiosyncratic issues with them. I guess, how are you thinking about our energy names or the energy sector in general?
Yeah, I mean, I think energy is attractive. I could get worse before it gets better. You never know. People are pretty bearish on the prospects for oil prices over the next year, but people mostly don't know anything about that. And the stocks, overall are priced, below what we consider normalized crude, which is in the mid 60s. And so it's not we do have a significant weight in the energy space. I think it's more on the offshore drillers, which, they have great balance sheets. I think they're very mispriced over, call it a 3-year basis. I think they've taken a ton of supply out. They could have huge pricing power. I would have more in the portfolio, except I have to sell something to buy those names. And so that's just a very high bar. So I think they're attractive overall. And if some of our other names, run up enough that they're closer to value, we would be adding probably to that area of the market.
Great. Just a few more questions I'm going to try to sneak in here. Someone asked for our thesis on our top 5 holdings. You already hit on a few of them. Norwegian, and QXO, but can you hit on our other top 5 names just and give a high-level pitch on why you like them?
Yeah, I think I believe the other names in the top five, again, Precigen is at the actually the top if you look at all the different securities. I've touched on that. Google has done great. It's had a big comeback year to date, up 30%. We still think it's extremely attractive. It's trading at 25 times this year's earnings, 30 times next year's earnings. I still hear everywhere I go, oh, Google's at risk of disruption from all these AI companies. It's possible. There is obviously, it is changing behavior in terms of how people operate, but I think Google has some of the best assets, and they, in the past, to these sort of threats have responded excellently, and I see them doing that again. And so, we're actively looking at using AI tools internally. Christy, you were just telling me today that for something you're doing, Gemini model was the only one that could do it. And so I think it's the best model, for many things. And they have a huge asset in terms of controlling, internet traffic flow now. And so far, we have not seen traffic to Google decline. And people are mostly using these AI, as market growth potential. I think YouTube's a huge asset. Waymo is advancing. So I think they have leadership across a variety of areas, DeepMind, and in terms of the healthcare space. I think they have a great hand in AI. And, and again, until I actually see evidence that the fundamentals are starting to disappoint, that's when I'll get more worried about the risks. Right now, I have not seen that.
Yeah, I was gonna say exactly, like, this goes right into our expectations versus fundamentals. Like, we're not seeing it in the fundamentals, and expectations are low because you have all these very negative headlines grabbing people's attention.
Yeah.
I think the other name to hit on would be Citigroup. You briefly mentioned that.
Yeah, Citigroup, again, we still own it. We still really like it. They just announced great earnings in the quarter. Their return on tangible, common equity was just shy of 10%. That's way better than people expected them to do. Their target for next year is 11 to 12%, and they say that's just, they're going to continue to improve it from there. So the stock has a $96 tangible book value. It's trading at 98, so it's just sitting there at tangible book. As they improve that, return over the coming years, that valuation should increase. So again, if we look at what we think this company can earn over the next 5 years, we think it can earn close to $16 a share in 2029. If it trades at 13 times, it'll be a $200 stock. So that would be a double from here. I mean, obviously it's cyclical, but we think the big banks are very well positioned. If we do have a credit cycle, which I don't think these defaults that we're seeing are emblematic of a credit cycle. I think it's more one-off. All the banks just announced great results, great credit performance. You're seeing one-off things here and there from Zions and Western Alliance. That's not systematic, I don't think, yet.
And we're going to end on the last question. It comes full circle. So someone asked, going after last quarter, you mentioned the Zen mind. So how do you keep the Zen mind during periods of heightened volatility?
Yeah, well, it's interesting. One, I do a lot of active stuff to try to get a Zen mind. So meditation and this neuroemotional technique I do with a practitioner, and all of that stuff helps clear away stress and emotions and help you think clearly. And so I think actively, embarking on things that can help you is very helpful. I think, my mind, everyone's mind works differently, and it's really important to understand your own personal mind and how it works so that you can do things that help you. And so, like I told you, in 2008, I was like, oh, this looks like a great opportunity. Now, I wasn't managing client money then, which makes it much easier, but I like weak markets. Because I know the values, I see what to do, I can deploy into that, and I love that. And I get much more nervous in very strong markets. And so I'm like a paranoid optimist. So again, I think we're just, trying to be all over everything that we cover and make sure that we're not missing anything, make sure we know the fundamentals, make sure we know the bear cases out there. That's critically important, so that we can assess them relative to what we're seeing. So again, but I think sell-offs are great opportunities, and we have a great history of capitalizing on those. What I want to make sure we capitalize on is when we finally do reach a secular peak, I want to be well positioned for whatever comes next.
Great. Well, that's a great way to end it. As we said earlier, we will make sure to get back to anybody's question that we were not able to answer live. And then Sam, I'll pass it over to you for any closing remarks.
I just want to thank everyone for joining us again. I know time is your most precious resource, and these calls can go long. We always aim for 45 minutes to an hour, but then we get going. And so I appreciate your time. I think it's a really interesting market environment. I think we're not in a bubble, so, that doesn't mean we couldn't have a sell-off, but I think it comforts me to hear all of this negativity. And that's a good thing in markets when people are negative. So I think we could have some very strong returns from here. And I think from our perspective, we want to be positioned to capitalize on the strong returns and also, again, whatever might come next. And so that's what we're focused on doing. And if you have any questions, comments, concerns, please reach out. We love engaging with holders and prospects, and are more than happy. Again, I know we didn't get to all the questions because there were just so many. And so last quarter, I think we were able to respond to all of them, and we will work on doing that again here. So thank you.